Hello, investors and traders, and welcome to the weekly market report. I'm AJ Monte, and this is a one-year daily candle chart of the CBOE Market Volatility Index, ticker symbol VIX. I normally don't start with the VIX, but something happened today. It was very interesting, and I want to point that out to every one of our traders especially. And that is, while the markets were rallying, especially towards the latter part of the day, we had the VIX also rallying. Now, before I get into the intraday chart, let me just show you that my original forecast for the VIX was that we would go lower and then start to move higher. If you take a look at what we have right now, we have 5 red candles in a row. That's known as a stale red light. We're long overdue for a green candle. And with that, we have very close to a hammer pattern, which is bullish. And remember, this is the VIX, and for the most part, it's inversely related to the S&P. In addition to that, take a look at the wide divergence between the K and the D. I often talk about the stochastics, but most importantly, if you look at these divergences in the past, when that blue line, which is the percent K, moves far away from the red line, which is the percent D, we generally get reversals. See, back here we saw the same divergence between the K and the D, and shortly thereafter we had that big pop in the VIX. Well, what do we have right now? Again, another big wide divergence that matches what we had back here. Now, with that, I do believe that the VIX is going to rally early next week. Now, please remember that this is not a guarantee that the markets are going to drop, nor is it a guarantee that the VIX is going to rally. We have to look at the charts and say, okay, what's the probability of these things occurring? And as I look at the charts, I have to go by the charts. I cannot go with my personal opinion. I do have personal opinions on the geopolitical front, but I don't have any opinions on the charts. I'm just reading the charts as we see the signals. And if you look back here, we had a series of highs that was broken, and that is known as role reversal. Former resistance back here and here, once broken right there, turns to support. So we're reaching this level of support on the VIX. So keep that in mind. It's why I started with the VIX. And if you look intraday, this is what I was talking about, intraday, right up until the end part of the day, right around 11:45, while the markets were rallying, the VIX was also rallying in an intraday uptrend. So this is something you don't normally see, which in some instances will even create some confusion here coming into early next week. But I'm going to go with the VIX, and I'm keeping that upside target up there at 34.66. One other thing with regard to the options, if you look at the November option, the open interest is phenomenal right here. Look down below, and you'll see the $50 strike price currently has an open interest of over 300,000 open interest. And look at all the open interest on the calls moving at the higher strike prices. We don't see anything like that on the puts. Now, you don't have to be an options expert to understand what I'm about to say here, but I wrote a white paper for the MTA talking about pin pressure, and it is a fact that prices move towards the open interest that has the highest level. So right now, high open interest here at the 35, high open interest at the 40, super high open interest at the 50. And again, if we go back and look at the chart at those levels, starting at the $35 strike price, well, what is that? That brings us right to my target of 34.66. So that is the VIX. Now, on the other side of the coin, we have the S&P. The downside target obviously was not hit, but I am going to keep that downside target and then give you a little bit of interim forecast here early next week and into mid next week. What I'm going to do is I'm just going to draw a green dotted line right at my target. I do believe that we will hit that. We might hit that before midterm elections. We'll have to see. But there's a lot going on pre-midterm elections. You see a lot of manipulation. That's what happened today. We had just talk of the Fed not hiking 75 basis points. That is not easing, folks. If the Fed is not going to aggressively hit the interest rates, then that is taken as bullish. But we're still going to have to increase interest rates to get ahead of inflation. The Fed is still behind the curve on that. I'll get to that in a little bit. But we have a bullish engulfing candle right here on the S&P, which is the SPY ETF. And we have a resistance right above that. So for next week, because of that bullish engulfing candle, I think we could go up just a little bit like that. And then I'm going to continue down with a longer term target. See, what I'm doing here is I'm basically keeping that same angle, but I'm projecting that out. That's going to bring us right around the midterms right here. There's going to be a very interesting time as we approach that election, and then we're going to have to see what happens after that. So that's SPY. If I look at the diamonds, you'll see right here, it's going to be pretty much the same scenario. Bullish engulfing. This one broke out over resistance here. The next resistance is going to be this gap fill. I don't think we're going to hit that, but that's going to be a resistance point. I do think, however, that will come up and then come right back down. I will be keeping that longer term downside target down here. I don't want to confuse anybody with all the targets, but option traders need to know this for adjusting their spreads. And if you're part of our Option Oracle Trade Alert service, every single one of the positions that we have right now are doing extremely well. The large majority of positions we've taken over the course of the year have made money. We are negative delta, which means we're still geared up for a bear market with bearish positions, and those are looking very good. So the option traders need these support and resistance levels to help them adjust their positions. And if you're an option trader, shout out in the comments field down below. Love to hear from you. I know we have a lot of questions coming in. I try to address as many as I can, but when you have hundreds of questions coming in, I'll just do my best. I can't answer every single question, but I'll absolutely do my best to try to get as many as I possibly can answered. All right, so that's DIA. Again, upside target, 314.78, and then right back down where we are right now, right around 304.34. So that's DIA. If I look at the IWM, which is the Russell 2000 ETF, this one's a little bit different. Does not have a bullish engulfing candle. Nope, it was a green candle on higher volume. Oscillators are starting to go up, but that is not a bullish engulfing. So we could see a test of that resistance high right there. I'll leave it at that, and then again, still leaving that downside target for a longer period of time, right around the midterm election week. All right, so this upside target for the short term, the very short term, 175.66. If I look at the Qs, QQQ, you'll see right here, that is a bullish engulfing candle on higher volume. Oscillators are starting to go up. And guess what? We got a gap fill above the market. This is a high probability trade here where I think we're going to go up to fill that gap. I'll leave that upside target in place, and then we'll have to keep an eye on volume. So right on this one, the Qs, keeping an upside target at 279.61. Keep in mind that coming up, we have Meta coming out with earnings. We have Amazon coming out with earnings. But if you look at Tesla, Tesla rallied before the earnings came out. You see here, I'm just using this as a guideline. Tesla rallied right before the earnings, and then it dumped right after the earnings. You can see this was a forecast target that we put out to our traders on Wednesday, and we absolutely hit that downside target at 205.01. So I think you're going to see that in some of the large cap stocks like Meta and Amazon. And then after that, we'll have to see whether or not the market holds up, because if the large cap stocks start getting hit after earnings, that's going to bring the whole market down with it. Okay, so we did the diamonds, we did the Qs, we did IWM, we did the spiders and the VIX. Now let's talk a little bit about the geopolitical events that are happening around the world. For those that don't want to participate in that one, you could bail out and we'll talk to you next week. But I think it's very relevant and very important to talk about if you're a trader in this market. Taking a look at this, very interesting. Last Friday, this came out after I'd already recorded the market report. We have a problem going on in the Mississippi River. Water levels are at record lows on what is one of the main arteries for delivering products and goods, especially when it comes to agriculture. So these barges are stacking up, and that is not going to help the supply chain. Now, going to energy, look what's happening. This came out on October 17th. China has stopped reselling liquid natural gas to Europe. Right, so there's the crisis magnifying right there as we come into the winter months. You can see off the coast of Spain, the ships that are carrying the liquefied natural gas are unable to get into port. This is baffling to me, because why wouldn't they? It's not like the ports are shut down like they were in COVID in China and out in Long Beach in California. This is just popping up in sequence with what we're seeing around the world. Again, liquid natural gas seems to be under attack, and I'm going to get to that in a little bit. Now, look at this. Moscow still hitting the energy system. Right now, Ukraine is down, I think, 30%. Last report, their electric grid is down by 30%. So that's going to put a hurting on the citizens there. And you can see with the cost of freight rates for LNG going up, and eventually this is going to contribute to higher inflation down the road. Now, the Nord Stream pipeline flows at zero right now. They call it a glitch. I don't call it a glitch at all. I think this is designed to put more pressure on Europe. Remember, Russia is looking to have them lift the sanctions. The sanctions on Russia are backfiring on Europe. At this point, they've created a parallel universe between India and China. Now, obviously, it's going to cost them in profits, but it's not going to cripple them the way most people think. And I'm not going to go too far down that rabbit hole because I know there's people that take both sides of this argument. Why? I don't know. We need to stick together as a nation. We have our own problems right here. However, if you look right now at what's happening in the U.S., again, how natural gas prices rising will eventually affect our inflation numbers. Don't buy into the story that the Fed is going to start easing. They're not. Yeah, the talk of them not hiking as high as they originally announced is not easing. So that's why the market's rallied. So be careful of that, as you may get caught in a bull trap before you know it. And I think eventually, after we hit those resistance highs, I think we're coming right back down. We're still in a bear market. Now, this is where we start to get a little bit more serious because this is a national security issue right here. When they started announcing that they were going to release another 15 million barrels of our strategic petroleum reserves, this is when we're starting to look at a chart that's pretty amazing because we're now running on empty, basically. Remember, when Biden first came into office, the first thing he did was shut down the pipeline, right, and cancel the drilling leases. Right around the same time, they started releasing the strategic petroleum reserves. This is not a coincidence, folks. I keep telling you that. It's by design. They're putting pressure on fossil fuels. They're putting a hurting on us. And this leaves us with a 22-day supply of oil. If we're in an emergency, we have 22 days of oil, and that's it. We consume about 20 million barrels a day as a nation. And that leaves us to a record low level based on the consumption rate in today's world. So this is something that is very dangerous for us as a nation. If we ever run into a national emergency, we're not going to have the fuel to help people or bail out of a situation. So something to keep in mind. We even have U.S. Senator here, Jerry Moran, calling to stop the depletion of the National Oil Reserve. You could see why. It makes a lot of sense to me. It doesn't matter what political flag you fly. Remember, draining our emergency supplies is a short-sighted and dangerous choice that imperils our energy security at a critical time of global uncertainty. That is absolutely true right there. We should not be draining these reserves. We're not in a national emergency. And in order to replenish this reserve, as oil prices start to go up, it's going to cost us quite a bit. Remember, I'm bullish on energy. If you look at some of the energy stocks this week, they're all breaking out of highs. You look at OIH, you look at ExxonMobil, you look at Chevron, you look at all of them, they're breaking out over the highs. We're in a bull market in energy, and that's one of the few places that I would consider taking a long position. Right? So this makes a lot of sense. It's not a good idea to be draining our supply at this particular point. This is just classic. It makes sense. Why, if we're draining our reserves and there is a crunch and you want to keep the price of gasoline down, just open up the pipeline and renew the drilling leases. There you go. We're back to energy independence. That's it. We were there once before. We can go there pretty quickly once again. So that is what we have there. Now, on home buying and home building, the confidence levels are dropping quite dramatically. And you could see that the last time we saw drops like this was right before the crash of 2008. You see this segment right here? And the recent drop in confidence makes that look like kindergarten play in comparison. Even the builders are dropping a confidence level that's equal to what we saw back here. And so that's a straight drop down in confidence, and it doesn't look like we see any pivot points to the upside there at all. Now, if you're following Jeremy Siegel, he's been making a presence here on CNBC, very well respected. His analysis of the home prices is quite startling because he's calling for the second worst crash in home prices since World War II. And again, even if the Fed only raises by 50 basis points, it's still raising rates, and it's still going to put pressure on real estate across the board. Now, as we come into final comments here about the geopolitical events and what's happening around the world, this just came out yesterday, and our federal tax receipts are near record highs of the gross domestic product. What does that mean? Well, imagine this. Imagine you're on a fixed income and you just maxed out all your credit cards and you could barely make the minimum payment on those credit cards. And you call up the credit card company and say, listen, I don't know if I can make the minimum payment. They say, okay, we'll skip it, pay it next week. I know this is a scenario. It's not a real life scenario, but bear with me here. And then all of a sudden, while they're telling you, yeah, you could skip this month and pay us next month, you could double up next month, they then increase your credit line and you go out and spend more money. Well, this is exactly what's happening. That scenario I just described is happening right now. Americans cannot bear much more with regard to tax burdens. They cannot bear much more. And our debt is absolutely out of control, and they keep spending. This just came out today. A lot of people don't even know this. The Fed quietly sends, right, $11 billion to Switzerland. $11 billion to help bail out some of the banks that are in trouble. This is just the beginning of the dominoes going down, folks. This is just the beginning. If you're not paying attention to the global events, then you're not getting the full picture. I'm going to put out a forecast here for you. I've been looking at Bitcoin. John, Jerry, and I had a talk on Twitter. It was the first time we did that live broadcast. We did that Thursday. We might be doing it again next Thursday after the close, so stay tuned to my Twitter page. But look what's happening with Bitcoin. This red line is a longer-term downward trend, and that trend line is breaking by the mere fact that Bitcoin is starting to stabilize at this support level. So it's not going to be much longer before we start breaking out over this 20-week moving average right here. So I put an upside target. It's a longer-term target on Bitcoin. For those of you that follow Bitcoin or track Bitcoin, I'm putting a target of Bitcoin right around 28,000, and I'm putting that target out there until the mid to end of Q1 in 2023. So give this one a little time, but I think this is a good time to at least look at this as an alternative for cash. Just giving you some suggestions here. I'm telling you what I'm going to be doing, and I'm giving you the first shot to go do it. By the way, if you ask any of our members, I never trade ahead of the trade alerts that I put out. I always give our members a chance to do that first, and then I come in and I'll make the trade. But I'm trading like our members are, and it's very rare that you even run into analysts that are actually trading, putting their money where their mouth is. You know, I have skin in the game just like a lot of you, and I take this very seriously. I hope you do too. This is not for entertainment purposes. This is technical analysis. And like I say, over and over and over again, I'm not going to be right all the time, but I am right most of the time. And we may not have hit the majority of our targets this week, but I think we eventually will. You know, bear with the charts. Make sure you're managing risk. Follow the news, but dig for the news. Don't just turn on television and expect the news is going to slap you in the head. You have to go out there and search for it, hunt for it, and then make sure you draw your opinions from what you're seeing and then finalizing that with the confirmation on the charts. So that's it for this week, folks. Have a great day. Please make sure you like and subscribe and comment. Absolutely. I'm doing my best, like I said, to answer all the questions and the comments that come out. I can't get to all of them, but thank you, because that's helping us drive the video and this channel through the YouTube algorithm. And we're getting on the menu, which is why we're seeing more and more people watching the video each and every week. So again, thank you, folks. We'll talk to you next time. Bye-bye.
As traders, we are beholden to forces greater than any one person. Forces that can lift spirits or leave scars. There are those who passively resign to their fate, leave their decisions to others, and let the chips fall where they may. And then there are the rebels, a battle-tested team of expert technical analysts, astute educators, tactical momentum traders, crypto connoisseurs, and a select few who take the market head-on. so that they may have a say in their own destiny. Guided by the mantra, discipline dictates action. Discipline dictates action. Discipline dictates action. Today, we rebels gather, a community of mavericks, forging a path through the ups and downs on our own terms. Welcome to the rebellion.